Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon webinar series live today. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. One last look at that disclaimer, and let's welcome Dimitri Pargamanik to the stage. He's going to be talking about dark pool trading versus lit exchanges, and he's going to give a great explanation. How you doing, D?
Good morning. Will, how are you?
Great. Let me share your page, and there it is. We're on the Market Chameleon landing page.
Good morning, everyone. And yeah, we'll discuss today the differences between dark pool volume versus lit exchanges. And I think what I'll do is just navigate to a stock symbol so we can look at the breakdown and then discuss what that means. So let's go to Google. We'll just go to default Google, type in the symbol, you land on this summary page on the left-hand side. We're going to go to price action. So under stock info, we're going to go to price action. And this will take us to a new page where we have these different ways that we could analyze volume. And I'm going to just click on this menu to minimize it, expand our screen. And you'll see on the right-hand side, we have different choices here. And one is dark pool trading. So I'm going to click on that. And what we'll do is click on this volume by trader size. Okay. This kind of brings us this view. Let me click on this menu to minimize it again. And this kind of brings us to this view where we have volume by lit exchange, which is here in the yellow, volume in the dark pools, which is here in this like shaded dark area. And we also slice it by the trader size type. Okay, so if it's a small trade, we'll put it in the small bucket. If it's a retail size trade, but not exactly very small, but still in that area where we define retail trades, they'll come in here. The more professional size trades or institutional size trades are over here. So we have these four buckets and the breakdown of the volume. So first, let's just discuss the differences between lit exchanges and dark pools. And at one point, all the volume went to lit exchanges, meaning like it went to the New York Stock Exchange or the NASDAQ, right? So these are the established exchanges that orders are sent to. They have the order book, and then as the time went on, what happened was that the exchanges started to demutualize, become like for-profit centers. So at some point they were like non-for-profit. All the orders kind of went there. Then they became for-profit. Right now you could buy shares in an exchange, New York Stock Exchange and NASDAQ, and so you could buy shares. They're for-profit, and what happened was that when at one point all the resting orders went to the exchange, and the exchange had an order book that was dark, meaning that you couldn't see, besides the MBBO, the best bid, best offer, you couldn't see the order book beyond that. And the specialists could, the market makers would be able to access it, but they had strict requirements to provide liquidity. They couldn't, front run orders. You couldn't just say, oh, here's a big order, I'm going to run the book up. You weren't allowed to do that. That would be illegal. When the exchanges demutualized, they said, well, hey, look, we have this order book, and there are these big orders, below and above, and this is valuable information, right? Somebody would pay for that. So they became a profit center. So they applied to the SEC, and the SEC said, okay, you could sell that information. Well, the market makers and specialists, they have requirements, but other traders don't. If they sell you the information, you trade off it, that's fine, because you're just a prop trader or a trading firm or high frequency trader. That's how high frequency trades started. So what happened was, once they opened that up, and traders were able to detect, even electronically through computers, your big orders, they could trade off that information. And exchanges were charging money for that. So why did the dark pools then come into play? Well, then it became kind of unfair, right, for those institutions that needed, they relied on anonymity. They didn't want to expose their orders so somebody could go and front run it, right? They didn't. That wasn't their intent. But so what do they do? Because if you have to, then it was an unfair system. So the brokers, went to the SEC and said, well, we want to be able to create these dark pools where they don't have to, display these limit orders or their intent. Okay, so that's kind of like how the dark pool. So it's kind of important to understand where it came from. Why do we even have them? Okay. So how did the orders then? What are we looking at? When we look at orders, if you have an order to buy or sell, first it goes to the broker, right? So you enter in an order to buy or sell, you have to go through your broker. Then your broker, once they receive the order, they have a mechanism deciding where that order is going to go to get executed. And brokers always want to try to execute it within their own engine if they can, right? Or their own dark pool. Because if they can match, the more matching up of orders they could do in a dark pool and not go to the lit exchanges like NYSE or NASDAQ, well, it's better for them. It makes their dark pool more valuable. And keep in mind, like, a dark pool is not the same thing as a New York Stock Exchange where anybody could go and access New York Stock Exchange, right? Those are public exchanges. So if you want to route an order to New York Stock Exchange, you can. Dark pools are private matching engines, right? They're privately owned. So if you have a Goldman Sachs, for example, dark pool, well, that doesn't mean I could go and access that dark pool. It's not. I'd have to get approved, or my broker has to get approved by Goldman, to access, their dark pool. So there are like these key differences there, where there are many of these private, matching engines, but they restrict. Also, they have their own rules and restrict who can access the dark pool and who can't. So, for example, they don't want toxic order flow. They don't want high frequency traders taking advantage. They'll say, well, we don't want your order flow, or we don't want your order type because we're going to lose customers, because they don't want to. You don't want a customer where you're exposed to a high frequency trader because they have a faster system or plugged into some news, and then and scoop your customers' orders before they have a chance to react to the news. Right. So understanding how the dark pools versus lit exchanges work is key then to understanding like what is going on between the volume in the lit exchanges and dark pools. So if you're a dark pool, right, the most valuable order flow is retail and small retail. Okay, that's the most valuable that you would want to trade against, and the most valuable where liquidity providers want to trade against the retail order flow, because that's considered uninformed. And uninformed means that they lack the sophisticated research and speed that you would get from a non-retail customer. And it doesn't mean that ultimately that retail, you can buy Apple shares and make money on, right? But the point is that the moment that they put in those orders, it's not based on some disadvantage to the other side, okay, to the liquidity provider, because dark pools need liquidity too. So that's the most valuable order flow to any exchange, is the retail order flow, because there you're not expected to, on balance, have this disadvantage that you might get from a high frequency trader who can afford high speed networks and plugged into different types of informations that you may not be plugged into. And that's why when we see this breakdown, it starts to make sense, because small, how does the small flow look like? Well, you could see most of it goes into the dark pool, and that would make complete sense that, hey, if you have small retail order flow and you're a broker, you want to capture that within your dark pool and match it up with your liquidity providers. And some brokers trade against that order flow themselves, right? Because they could buy and sell from the retail flow. So you could see that as the retail flow gets a little bit bigger in size, it's still captured in the dark pools, but not as much. So the smaller the order size, the more valuable it is, because the less likely that retail order knows something, that is not, easily available somewhere. So as we go up in price, here's professional. So you can see now we got a little bit less, and then the really high institutional, even less than that. It's 60% end up going to the lit exchanges, and the lit exchanges are usually what the way the orders flow is they go through the dark pool, and then if you can't get executed in the dark pool, they go to the lit exchanges. So because once you put your order on the lit exchange, that's where it is. It doesn't go. You don't go in reverse. So it'll go through dark pool. If it doesn't get executed, it goes to the lit exchange. If it goes to the lit exchange, either it gets executed against a matching resting order, or an order that it could get matched up, or it'll get put on the limit order book, and then it will just sit until the market either moves to it and it gets executed, or if it never moves in it, it'll just sit there. So the lit exchange is kind of like that will be going there to access the liquidity that's seen, right? To grab that liquidity that's already resting and available. And institutions, they would, and think of it as like if you're an institution and you're trying to accumulate shares, the less you take from the limit order book, the better, because when you take liquidity from the limit order book on the lit exchanges, that moves the market, right? So the dark pools don't move the market because they don't touch that lit, bids and offers. But once you take the liquidity from the lit exchanges, that moves actually the market. So usually they won't access that lit exchange unless they want to grab, something that they think, well, I want to take it before somebody else does. So if you see a big block, if they're trying to execute a lot, and they see a very big block, like if you're trying to, buy $10 million worth of stock, and all of a sudden you're like, oh, wait a minute, I could get this all in one shot because I see an offer there, then they'll grab it. Okay. But if they don't see it, they'll try to stay in that dark pool and accumulate whatever they can. So now kind of that we get a sense of like how things work, then we could kind of see this breakdown. And here we see in Google that the volume, increased, across the board in the dark pools. So in the small, retail, professional, and institutional, right? So on a day, what we see is that there's more flown into the dark pool, more volume going, to Google, and it increased, across the board, right? So there's liquidity in the dark pool, for all trader types. And here's the breakdown in percentages, of those averages. Okay. Really quickly, I'm going to go through this last one, but this here gives us a breakdown at each level, the VWAPs, how they traded on the day. And this shows us volume bars and the breakdown between lit and dark. And here we kind of just want to see if it was proportional throughout. So if we had like one really big dark line, right, that would mean that at that point, most of the trading, it was done in the dark. So the dark pool you kind of hit a limit order there that wasn't like being executed proportionally with the rest of the volume. Could have been just like someone there decided, hey, I'll do a big portion right there, and it got executed. Or if we see unproportionally where there's a big yellow line and not proportionally a dark pool, that would mean at that level, the dark pools faded. They faded their liquidity, and the order flow was forced to go to the lit exchange. Right. So you found a pocket where, hey, even in a dark pool, something happened. They just faded their liquidity. It wasn't just being executed proportionally with the rest of the volume. Okay. So I think I'm going to stop there. We gave it a good overview for today.
Yeah, that was very informative webinar, D. Thanks for bringing us on the dark pool trading. Great job, my friend. We will see you tomorrow.
All right. Thanks, everyone, for joining. Stay safe out there, and we'll hope to see you tomorrow.
Great job, D. We'll see you tomorrow, my friend. Bye. Hey, everyone. Thanks for joining another Market Chameleon live webinar. For all those who are watching us and following us on YouTube, please thumbs up, always appreciated. If you're on any of this other social platforms, remember to like, follow. Everyone have a great day. We will have another live webinar Friday, tomorrow at 9 a.m. For you who are not following us on YouTube, if you go to the YouTube channel, we have hundreds, if not thousands, of informative videos on the Market Chameleon tools and products, and all those are free to access. So everyone have a great, safe trading day, and we'll see you tomorrow at 9. Have a great day. Bye-bye.